Good morning. Welcome to the Genghis Personal Investment Webinar. And today we are focusing on the basics of personal financial planning. And my name is Daniel Ogeto from the Marketing Department. And today's speaker is Caleb Mugendi, an investment associate at Genghis Capital, who will be taking us through today's presentation. And we hope that you are eager and ready to learn more from him. Over to you, Caleb.
Thank you, Ogeto, for the introduction, setting the context. As discussed, my name is Caleb. I work at Genghis Capital in the investments department. So today we're going to have a training on understanding your personal financial planning, how to develop a personal financial plan, what is the steps to look out for, what are the pillars of financial planning, and just how do you get on track in terms of getting your financial plan in place so that you can go through this year having a savings plan, an investment plan, basically having a roadmap in terms of how you're going to approach your finance for the better and also for your financial freedom. So today we'll start the presentation with the understanding of personal financial planning. Just a brief overview of what personal financial planning is. This is a systematic process of individual to utilize the existing financial resources in a manner to achieve your financial objectives. So it's a process where you basically utilize what you have in the best way possible in order to achieve your goals and your objectives. It also helps you determine your short-term and your long-term financial goals, which is very key. To have goals that you want to achieve, let's say in the short term, that is between anywhere from 1 month, 3 months, 1 year, 3 years. And what you want to achieve in the long term, that is from anywhere from 3, 5 years, 10 years, 20 years. And then the financial planning also helps you to create an effective plan in order to meet those goals. So some of the reasons why your finances, basically you need to plan your finances because you have unique situations, you have unique characteristics, you have unique resources, unique skills, unique situations, and you also to be able to utilize your available resources in order to best bring out that unique position that you have, and in order for you to best meet your specific goals and your specific needs. Also to ensure that you have an emergency fund when you're out of a job or if there's an emergency. You see, like what happened last year, we had the pandemic coming in. A lot of people who suddenly found themselves either out of a job or with a reduced income because of the way the pandemic ravaged the economy and businesses, and also because of the measures that were brought in to try and mitigate those that spread of COVID. So you need to have a nest egg. Basically, if you set aside some of your living expenses, your cost of living expenses, between 3 to 6 months. Ideally, try and target 6 months of a nest egg, basically a buffer, so that even if you're out of a job for 6 months to say, you're still able to maintain your standards of living. You don't have to, if you're paying rent, you don't have to go to a cheaper house, move to a cheaper house, or if you're eating 3 meals a day, you don't have to start now cutting that down. And that's the necessity of having an emergency fund. And using your personal financial planning, you're able to plan for these unexpected emergencies. Also, to continue the same standard of living before and during retirement. When you're retired, basically your salary that has been your main source of income for most employed people goes out the window because you're now retired. And then a lot of people did not understand that during retirement, you also need to be able to live how you were living prior before your retirement. That basically means that you need an income replacement ratio of close to what you are earning as at the end of your retirement. And how do you do that? Using your savings, using your retirement benefits, building up other sources of income, so that when you do retire, you have a financial plan that enables you and your family to continue living at the same standard of living. Finally, also you also want to plan your finances to get financial freedom, basically to have enough savings, financial investments, and cash to afford the kind of life you desire for yourself and your family. We'll move on to the second portion in terms of financial planning process. So what is the process of planning for your finances? Basically, you can define it into 4 main steps. You first start with determining your current financial situation, developing your financial goals, creating and implementing a financial action plan, and then you review and revise your financial action plan. And this process of planning enables you to immediately assess what your current financial picture is and prepare for your future financial situation. You're getting a glimpse of how much you're currently your current financial situation. Are you in debt? Do you have a lot of cash flow? Where is your money going? And then it gives you a starting point or a base to where you can now proceed in the future to get to your intended goals. So financial plan, as we highlighted, is a personalized roadmap to financial security. It covers everything between now and retirement. So you are able to identify metrics by which you'll measure your progress, thereby allowing you to maintain focus on this financial plan. You're able to identify where your strengths and weaknesses are, and also once you identify that, you're able to tackle it, focus on it, and overcome the setbacks that you possibly might have in achieving your financial stability. So go through the 4 main steps just to highlight the process. So we start with determining your current financial situation. We'll go to the next slide. Yes, so to determine your current financial situation, basically, in determining your current financial situation, you need to compute what is your net worth. And net worth is basically just a sum of all the assets you own versus the outstanding debts that you owe. It's like a personal balance sheet to say. So what do I own? These are my assets. And what do I owe? These are my debts or my liabilities. So you add these 2 numbers together, and if you come up with a positive sum, you have a positive net worth. And if you add them and come up with a negative sum, you have a negative net worth, meaning that you owe more than what you have in terms of assets. So why is it important to compute your net worth? You have to understand your net worth helps you put in perspective the importance of your liabilities. You have to understand your debts, because debts are the main liabilities, and how you manage them usually is one of the main reasons why people are able to become financially stable, and others are not able to become financially stable. So you examine the money that you owe people. This can be creditors through banks, lenders, SACCOs, soft loans from friends and family. You sum up all these net worth, all these debts that you have, which are your liabilities, and then you're able to examine them and know how much you need to get through to determine a pathway, basically determining a pathway to pay off your debt and prioritize more cash flow to yourself. And also good in terms of a critical tracking of your progress over time. There's no better way to actually measure your wealth than looking at your net worth. And if you understand your net worth today, you can set objectives for how you want your net worth to grow over time. So the critical thing here is tracking your progress over time. So how do you calculate your net worth? As we said, it's just like a personal balance sheet. And this is an example of your personal net worth sheet. So you can see we have assets and we have liabilities, and then we have the net worth, which is your total assets minus your total liability. So assets are basically things that you own. You have cash, in hand, cash in your pocket. You put that somewhere. You have your bank current account or your savings account. You put that also as your asset. You might own some property. You can have ownings of land, buildings. You can have a car. Those are your personal property. You can sum that up and also put it there as an asset. You can also have an investment portfolio. Have you invested in stocks, shares at the MSC? Have you invested in bonds, treasury bills, commercial paper, debt, bank deposits, and the like? Have you invested in investment funds, unit trust funds, collective investment schemes? All those are also added up in terms of your assets. Finally, do you also have a pension plan from your employment that you contribute to monthly? This is contributing to your retirement as during your working years. And your employment pension plan is also an asset because it's funds that you're going to be able to access upon your retirement. And finally, do you own a business? Are you a sole proprietorship? Do you have shares in a company? Do you run a business? That is also has value and is also part of your assets. So you sum all these assets up. These are just examples. There are other, basically anything that you own that has value and that you own can be put as an asset. And then you sum these up to get the total assets that you own. Then we come to liabilities. Liabilities is what you owe other people, creditors, lenders, and the like. So here you look at your debt. This can be anything: bank loans, circle loans, other loans, mobile loans. All this is debt that piles up and is a liability because you have to repay the debt plus interest. Have you taken a mortgage and you have a balance in terms of clearing that mortgage? That's also a liability. Do you have any credit card debt? Do you have any other debt or other tax liabilities? Let's say you do not declare enough tax and then there's a liability that you're supposed to pay. That is also a liability. Basically, how much do you owe other people? You sum that up in your debt and in your liabilities, and then you get the total liabilities that you owe other persons. So your net worth is basically now your total assets minus your total liabilities, and that is the figure that we want to focus on in terms of growing you, in terms of figuring out how to build your financial plan. So when you have gotten your net worth, you're able to get your net worth today is X. Let's say you want to grow it over time to 10 times X. What is now the plan to grow that net worth from today to that 10 times? That's what now you have to put into a financial plan. We also have a personal net worth exercise just to determine whether you are on track in terms of your net worth versus what is a median or expected net worth for you based on your age. So there's a wealth equation. It's a simple equation that was developed by a professor and a writer of financial books that can be used as a rule of thumb in determining if you've created enough wealth based on your age or based on your annual household income. So the wealth equation is equal to 10 times your age multiplied by your annual income. So this is your gross annual salary for all the 12 months in a year. Then you get 10% of your age and multiply by that. That is the wealth equation, and that's what you're going to have a discussion to see if your net worth currently, after you've done the net worth, your personal balance sheet net worth is equal to this equation. So looking at your personal net worth exercises, this we can all do. You just take your age currently. If you're 40 years old, if you're 30 years old, I don't want to say 20 because you might not yet be you might not yet be earning any income. So 20 years might not be the best. But if you're 30 years, if you're 40 years old, if you're 50, you can easily do this. So take your age and you divide it by 10 to get the 10%. So if you're 40 and you divide by 10, you get 4. And then you multiply this by your annual gross income. This, as I said, is your monthly salary for all the 12 months in a year. and then you multiply this by the figure that you got. So if you're 40, you divide that by 10, you get 4. Let's say your annual gross income is 1 million, then your net worth should be equal to 4 million. So I hope we're able to do that. If you're 30, you divide that by 10, so you get 3. You multiply by your annual gross income. Again, if it's 1 million, your net worth should be 3 million. So I hope we're able to quickly do that equation and get a score from the wealth equation, just to see whether we are ahead or below the expectation. So I know we can do that. We can give even everyone a 1 minute or so to just finalize that equation and see whether you are above or below. It's just a mental check, a quick check. As I said, it's just a rule of thumb. So it's nothing is cast in stone. Even if you are below what you're expected to be, don't worry. That's why we're doing this training, in order for you to develop your personal financial plan. All right, cool. Okay, so then we'll go into developing financial goals. This is the second step and is quite key, because without these financial goals, then we're not able to know whether we're hitting them. Basically, these are metrics that we strive to achieve. And that's why it's of paramount importance that we develop financial goals. And not just any financial goals, but specific financial goals that are SMART goals, that are specific, measurable, time-bound, accurate, and all that. So it's often easier to reach your long-term financial goals if you identify them in advance. Basically, you have a place where you're aiming for. You have an end goal in sight, and that's why it becomes a bit easier to achieve them. If you've set them down, you've written them down, you've divided them into long-term goals, short-term goals, and that way it also builds momentum. Once you achieve a short-term goal and another one, in the long run, you're also working on your long-term goals. So it's also just a way to achieve momentum in your financial plan and have specific things that you want to aim for. So basically, you can draw your financial goals from your financial values, and you do this by identifying how you feel about money and why you feel that way, and basically what you feel about your finances, about money. What does that money mean to you today? And basically, this purpose is to try and differentiate from your needs and your wants. Like, you can feel like, I really want to buy a car today. However, it's more of a want than a need. Let's say if you have anything more pressing, let's say between buying a car and maybe educating yourself or your children, then you know what is a need and what is a want. And then this is how you start drawing upon how you're going to develop your financial goals, because you know what exactly is a need. So you put that as a more pressing goal in the short term to work on your needs, and then in the long term you can work on more of what is we can put as wants. Another example is you might want your own home. However, you need to pay rent at the place that you are currently staying. So having those financial goals, differentiate them into needs, into wants, gives you at least a foundation of how you feel, of how you're setting them for yourself. Because remember, you're the only one who can set these financial goals for yourself. You're the one who knows your own situation, the situation of your household, and you're the one who is able then to put pen to paper on those goals, short-term and long-term, and work towards them. So setting financial goals, especially SMART goals, allows you to take stock of where you are now and measure that against where you want to be in the future, and it gives you an idea of how effectively you're moving towards achieving them. And you can range them again into short-term and long-term. That is what is actually a best practice. And they can include, some examples include building an emergency fund, totaling 3 months of income within the next 6 months. As we said earlier, that's one of the main things of financial planning, trying to build a nest egg or emergency fund, whereby if anything anything happens to your current situation, you're still able to withstand and maintain your current living standards. Pay off all credit card debt in the next 2 months. You see, these are what we're calling SMART goals. They have they are measurable. They have a time limit, and basically they're not vague. Like I just want to pay off debt, or I just want to build an emergency fund. It's more specific. Being I want to build an emergency fund. It's measurable, given it's 3 months of my current income, and it has a timeline of within the next 6 months. Pay off all my credit card debt. You see that has a value in the next 2 months. It also has a time limit on the same. So these two are examples of short-term goals. Let's look at another one. Retire with a retirement income replacement of 80% by the age of 65. So you see, this is also a SMART goal because you have an age, a time limit on it. You're specific. You want an income replacement of 80% within the next, by the time you're retiring. And finish paying off mortgage on a residential home in the next 10 years. So you have a mortgage, you want to pay it down on your home in the next 10 years. It's also time bound, and that's why these are goals that you can actually work towards, given that they're put with some specificity in them. So we can call these SMART goals, and also encourage you. I encourage you to write down financial goals, and when you're developing them, try and develop them SMART. We move on to creating and implementing a financial action plan. This is now the third step. After you've figured out your net worth and written down your financial goals, you now create and implement the financial action plan. So in this step, you develop your action plan, and it requires choosing ways to achieve your goals. As you know, it's not easy, but writing them down is not the whole process. Yes, it's a start, but you now have to create and implement the plan. So after you have your goals, you have them in short-term and medium-term. Once you achieve a short-term goal, then the next goal will come in priority, and then will become the focus. So a key component in implementing your financial plan is having a budget. A budget is just basically a plan of how you want to spend your money. So you don't spend money haphazardly. You're not quickly, it's called something like jitters. Once you're paid, you have a lot of jitters, you want to spend your money. But once you have a budget, you know how much you can spend on any particular item. So your budget basically is able to direct your estimated personal income towards expenditure, repayment of debt, and saving. And it's a guide on and a control of where your money should go. So a simple way to establish a budget, we can go with the 50-30-20 rule in establishing a budget. So you determine your 3 essential categories. So you have your needs, you have your wants, and savings. So you can calculate your net income and spend 50% on needs, 30% on wants, and 20% on savings. So that's an easy way of coming up with a budget, because if you do not budget for your income, then even implementing your financial action plan will become quite a foolhardy event, because you will not know exactly how much I'm supposed to allocate towards achieving one goal. How much am I supposed to allocate towards achieving the next goal, and the next, and the next, and the next? So you need a bit of a structure. So that's why budgeting is quite important. Have a list of your needs. That can be your expenses, things like you need to eat, you need to pay your rent, you need money for transport to and fro your places of work. So those comes under your needs, because that is basically how your basically your cost of living and your living standards. And then you also have your wants. Maybe something has, maybe your phone fell down, it has broken, so you want to repair it. Your shoe, you want a repair of shoes. Those are wants now. And then you have savings, which is quite essential to put apart some of your your income into savings. Savings, as we said, go into building your nest egg and into building some form of financial security. Furthermore, to implement your financial action plan, once you've written your goals, your short-term, medium-term, long-term goals, and you have your budget in place, you're now coming to implement them. Let's say you also want to invest some money in the stock market. You want to put some money in the stock market. You want to buy a plot somewhere, some land somewhere. You want to invest in a business, or maybe start your own business. All these require action. So that is the implementation. That is the getting up and doing the actions yourself. However, it doesn't mean that you have to do all those actions by yourself. You can also get assistance from professionals. So things like opening investment accounts, brokerage accounts, trading some securities, buying securities, consolidating your debt, etc. All these are actions that might be required to be implemented via your financial plan, but it doesn't mean that you have to be alone in this journey. So you can seek assistance from professionals. That is, you can look at a financial advisor, you can look at a wealth manager who will assist you in identifying which investment assets are suitable for you and help you on this journey towards achieving your financial stability or freedom. Okay, so after doing the 3 steps, we now have the 4th and last steps in your financial planning. The last step in your financial planning, and that is to review and revise your financial action plan. Because financial planning is a dynamic process, as your financial circumstances may change. So you need to regularly assess your financial decisions. Changing personal, social, and economic factors may require more frequent assessment. Basically, life events, like let's say you get married, for instance, so you now have, in a household, you now have 2 incomes, or you change your job, you go into a higher paying job, then your circumstances has changed. So now you have more income coming in, or let's say you get a kid or 2, that also brings in more change in your financial situation. So you need to review and revise your financial action plan to factor these things into it. So that's why you need to monitor and review your plan from time to time in order to remain relevant and up to date. So as you said, career and income changes, emergencies can also come up, and this will result require you to change or reassess or reevaluate your financial plan. Also, your financial planning process will be able to provide you with structure to adapt to these changes. Basically, you might figure out once you get children, all your funds are going to that end. Let's say if you start making more funds, but your savings and your savings are still the same, your financial plan will be able to get that out and push you to also increase your savings in tandem with your increase in income. And that's why it's very important for that structure to be in place through a financial action plan in order to capture these changes in your ever evolving and dynamic changes. That's why it's prudent to have a financial action plan in place. Okay. So some of the factors that influence your personal financial plan are just things that you should look at when you're developing a financial action plan. Look at your employment status, whether you're employed, unemployed, self-employed, or retired, influences the certainty of your income and your cash flows. That's very key in terms of making sure that you have income and the certainty of your income and your cash flows. Because when you're developing a financial plan and you're, let's say, unemployed, you can't say for certain that you're going to have income at the end of every month or quarter, for example. So it factors in to whether to the decisions that you're going to make in terms of growing your net worth and in terms of hitting your short-term financial goals. Marital status, as we've talked about, if you're single, married, divorced, or widowed, it can influence how you plan for you and your family's finances and expenses. Of course, if you're single, you're only planning for yourself. If you have if you're married and you have a household, then you might need to also plan for your dependents. Looking at income, the amount of income you generate also influences how you plan for your finances. As we say, the amount of income that you need still to cover all your needs is different. Obviously, also depending on a number of situations where you're living, availability of food, and the like. Your age also includes also influences your personal financial planning. If you're nearer to retirement, or if you're just starting out in your journey in terms of becoming employed, that also factors into how you're going to approach your financial planning. Number of dependents, if you have children, their ages, if they're still depending, if they're going into school and something like that, if you have parents, other family members that are relying on you for financial support, again, that influences how you're going to come up with a financial plan. Economic outlook, the economic and business performance, we've come to understand this is very critical, especially given the results of last year and the pandemic. So basically, if you had expected your business performance to be very good, and then and that will put you on track in terms of hitting your financial goals. But then things happen, and the pandemic came and ravaged the economy, and then your business outlook is not as good. So this is also influencing how you're going to approach your personal financial planning. Levels of interest rates, employment levels, inflation rates also affect your financial planning. Interest rates, how cheap you can borrow funds and debt is a factor, because if you want to take on good debt, employment levels in the country, if they're going up, is also a good thing. And then inflation rates, if you have a very high rate of inflation, then that also erodes the purchasing power of your income, and makes it even more paramount for you to have a financial plan and a way to continuously be growing your net worth. And also health status of you and your family members and dependents also affects your financial planning, because that also affects your productivity. So those are some of the factors that influence your personal financial planning process. And we can't only stop it at there, because it's also key to look at the pillars of financial success, and focusing on these pillars will enable you to also become much more attuned or adept in your personal financial planning. So what are the pillars of financial success? We have four. We have four pillars of financial success, basically on your road to financial stability and freedom. And the first pillar is income. So before you start building the other pillars, and in order to achieve financial ability, you need to have a source of income. A source of income basically gives you capital to start planning for your financial success. So developing ways to grow your income annually and having more than one income stream allow you more capital to achieve financial success. Basically, having more than one income stream is preferred, because if you have income from your let's say you have employment, you have income from your job. Let's say you have a business, you have income from your business. Let's say you have an online gig or marketplace or something. You also can get income from that. Let's say you also have investments. You can get income from your let's say dividends. If you invested in the stock market, get income from dividends. If you invested in the fixed income market, you can get income from interest payments and the like. So as you grow your income streams, then it becomes more easy for you to achieve your financial success and financial stability, because you have more ways to earn capital, and you have more capital to use. The second pillar is expenses. So we all incur expenses to maintain our living standard. It's part of it's part of living. You have to incur expenses. So to get on top of your expenses, it's best to group your expenses into necessary expenditure and discretionary expenses. And then you find ways to cut down on your discretionary expenses. You see that nice looking suit or jeans, clothes in the shop. What do you do if you're an impulse buyer? You'll buy, but these are discretionary expenses. So try and limit your discretionary expenses. One way, as we talked about, is by having a budget. So when you budget for all the income that's coming in, then you can put discretionary expenses into wants, and you can manage those wants appropriately. Also, in terms of expenses, just spend less than what you earn. Is one of the key mantras that is good to understand, so that you don't get yourself into what we call a debt trap. And the way you get yourself into a debt trap is by consistently spending more than what you earn, by funding your lifestyle through borrowing. So you fund your lifestyle through debt, through soft loans, and the like. So basically, let's say you do have an income, but by the 10th or 15th of every month, again, you're broke. Why? Because at the end of every month, maybe you have interest payments in terms of your debt to pay. You always have you're always spending more than what you are earning, and that is a vicious cycle. So in order for you to get your second pillar of expenses under control, it's good to start by spending less than what you earn. Then there's also debt. Debt is an expense that requires servicing through interest payments and paying back of the principal. However, there's also good debt. Good debt is debt that you take out as an investment that is expected to yield a form of future return. Let's say if you take a loan to start a business, that is a good debt. If you pay tuition fees, let's say for yourself to get skills, that's also good debt. And let's say if you're taking debt so that you can invest in an asset, that is also expected to yield a future return in the future, which is also good debt. Bad debt, on the other side, is taken for consumption. That is, to purchase discretionary items and maintain a lifestyle that's above your means. And the way debt is very easy accessible, we have the mobile payments, mobile apps that can easily pay you debt very quickly. You even have the Fuliza, the Mshwaris, and the like. So taking on debt has become quite easier than it was, let's say, even 5-10 years ago. So it's good to be armed with this financial knowledge that taking on bad debt is a vicious cycle, so that you can be able to avoid it. The next pillar 3 is savings. Saving money is not just about starting a savings account, but it lies in the consistency of topping up that balance and in that account or in any other savings vehicle that you may choose. It requires wise budgeting and cutting down unnecessary expenses, and it's basically a small sacrifice that you make in order to save your money, but one that also yields immense benefits in your journey towards financial success. So in order to become a better saver, we need to have what's it called, a delayed gratification mindset or attitude, where we don't necessarily buy all the ones that we want today, even if you do have the money, but you delay that and possibly cut down those unnecessary non-discretionary expenses. Some of the tips that you can consider to become better at saving is to purpose yourself to start saving as often as you can and as soon as you can. Basically, a change in mindset so that you can repurpose yourself to start saving. Also, treating savings as a necessary expense, like rent. The way you treat your rent, like every end of the month it is due, or you might be kicked out of your living quarters. So savings, if you can treat saving as a necessary expense, that every month you have to save a certain amount, then you'll become better at saving. You can also link your salary account to a savings or an investment account Therefore, once the money comes into your bank account, you detach it when you're paid, and that has a good way of removing any jitters you may feel by having money in your account. Always including a savings plan. Let's say having 20% of all your net income going towards your savings and adhering strictly to it. Building an emergency fund from your savings in an investment fund, like a money market fund, worth 6 months of living expenses to cater for any emergency or out of job situation, and also consider any insurance cover, such as a medical cover in case of large and unforeseen medical expenses. That helps you become a better saver. And one of the things that we do at Genghis Capital is we do have a way to track your savings through our Genghis Haba challenge, and we have a weekly calendar and tracker. So we start the first week with savings of 500 shillings, and we up it every week by 50 shillings, up until the week number 52, where you will have saved a total of 92,300 shillings. Obviously, plus the amount of interest that you earn with saving with us in our money market fund. This is another good way of tracking your savings. So even if you do have sporadic income streams, you know that every week you can save 500 or thereabout every week, and you can go increasing your savings for the year until the end of the year. And by the end of the year, you'll have a substantial amount. Even for the people who are salaried, you can still use this calendar. Basically, once you get your once you're paid your salary, you can pay the entire 4 weeks or 4 to 5 weeks of savings at once, and that way you're also going to be able to earn more in terms of the interest if you save in a money market fund. So I encourage you to join this savings platform. It's very easy to join them through investing money market funds these days, through the apps and through any interaction with our team members. And the fourth pillar is the investments pillar. And basically investing is the purchase of an asset with the hope of generating some income in the future, or the asset appreciating, hence being able to sell it at a profit. For investments, they're key to your financial success, because investments tend, if you buy good assets, they tend to generate income and grow in value over time. And this also brings you to be able to get another form of income, as we said, which is the first pillar of financial success. When you have more investments, you're able to increase the income that you're able to get every year through the return. So the returns from your investments add to your income, and that also brings you closer to your financial success. So the key considerations include risk. This is the uncertainty that an investment may not earn its expected rate of return, and return. These are the earnings from investments. They vary depending on the type of investments. You can get dividends from your your stocks, your equity investments. You can get rent from your property investments. You can get interest and capital appreciation. Let's say if you invest in fixed income securities like bonds, and capital appreciation, you can also get it from property. You can also get price appreciation from stock market shares as they rise in price. And return is the reason why people invest. Basically, if you take on more risk, you're supposed to be compensated with a higher return. You also consider liquidity, how quickly an asset can be converted into cash, and how quickly you as yourself will require that liquidity for any unforeseen opportunity or emergency. Investment horizon is the length of time that an investor intends to hold an investment, and is dependent on investors' income, needs, and risk exposure. So what is your time horizon? For some investments, you have a longer term horizon. For some, it can even be short term, and the different investment assets that meet these different times. Profile of the investors, depending on the type of client, the taxation should be well planned to avoid losing a large chunk of your returns in the form of taxes, and also any unique needs and preferences that you may have, unique consideration that an investor requires, like focus on environment-friendly investing. So those are the 4 pillars of success. In terms of investments, there are a number of investments that are quite popular and available to the public. And one of them is in collective investment schemes that we can call unit trust funds. And these are very common and very accessible, and you can easily start with small amounts of funds. So the most popular are the money market fund, the fixed income fund, and the equity fund. The objective of the money market fund is a stable return with emphasis on capital preservation and liquidity. The fixed income, the objective is stable capital growth over the medium to long term, and the equity fund objective is long-term capital appreciation. So the risk profile for the money market fund is a low risk profile. For the fixed income fund is between low to medium, and the equity fund is a high risk fund investment. And the money market fund asset allocation, it invests in short-term fixed income securities, including treasury bills, bonds, commercial papers, and bank deposits. For fixed income, it invests in fixed income securities, including treasury bonds, bills, and corporate bonds. An equity fund invests in equities that are listed on a securities exchange. So what return do you get? You get a return from interest made up from interest in your money market fund. You get a return made up from interest and capital appreciation in your fixed income fund. And you get a return made up from capital appreciation and dividends in your equity fund. And the time horizon for investors in money market fund is usually suitable for short-term investors. Fixed income fund is suitable for medium to long-term investors. An equity fund is suitable for long-term investors. So do you fit this investor profile? Are you suitable? Money market fund investors are suitable for investors seeking short-term parking bay for any surplus funds and are risk averse, or you prefer liquidity. For the fixed income fund, the profile of investors are seeking stable capital growth over the medium to long term and are a bit still risk averse. And the profile for equity fund investors are investors seeking long-term capital appreciation and are comfortable taking on some risk of potential capital loss. So these are some of the most popular investment, collective investment scheme that are available in the market and can assist you in achieving your fourth pillar investment goal, and in the grand scheme of things, also achieving your financial planning and financial stability goals. So they're available, and we encourage you to take part in that. And that brings us to the end of the personal financial planning training. We can engage on our mobile app if you want to invest in unit trusts, and we can also engage further if there are any comments or questions about the presentation. I'll hand it over to Daniel to take us through the next session. Thank you.
Thank you very much, Caleb, for taking us through the basics of personal financial planning. And I think from this presentation, we've been able to learn more about how to set up your investment, your personal investment plan, and the most important slide, where once you've set up your personal investment plan, you come and see where it is most suitable, whether it is in the money market fund or the fixed income fund or the equity fund. So it's now time for questions. And if you have questions, please direct them into the Q&A tab down there or in the chat section. Okay, I'm trying to access the Q&A section. Maybe my colleagues can actually help me deal with the questions that have come in.
Okay. Hi, everyone. So, Caleb, thank you so much for an awesome presentation. Lots of guys have found it useful, and you have several questions. So, Stephen Mimi asked, on savings, please share the tips on the best places to direct this money. Perhaps you can just receipt, because I remember you mentioned it in your presentation. Yeah. And then Vincent Okengo asked, please also advise on the risks with money market and how to mitigate them. So perhaps we could tackle those two first.
All right. So for Stephen on savings, best place to direct this money, as we discussed, we had that savings template sheet. Can they direct the savings into a money market fund? While a money market is a bit less risky in terms of your investment, and it's also very liquid and for risk-averse investors. So your savings, you can direct them into a money market fund, so they can also earn interest. You can also direct them into saving accounts, fixed saving accounts in your bank or microfinance of choice, where you'll also get interest return. Basically, we don't want your savings just to lie idle in your bank, because of a lot of things. You don't earn any return from them. There's inflation that erodes your purchasing power. And also, you also want to keep up, you don't want to be able to easily access it in case you have an emergency or you have any want that you want to pay for. So that's some of the tips. You can do a money market fund, fund, or you can also do a savings account, maybe a fixed deposit in your bank account or your microfinance. And on the risk of the money market and how to mitigate them, basically for money market, the risks that we see are investing in, let's say, companies that do not give the return as stated. Because you see, for a money market fund, you are regulated by the Capital Markets Authority. So you are regulated on how you can invest these. The fund manager is regulated on how you can invest these funds that they get from the investing public. So there are different bands and limits. Like for commercial paper, the limit is 25% in totality. However, every fund manager also has their own risk levels and measures. They say you don't want to invest more than 10% in any particular issue or in commercial papers as a whole. So the money market is much more risk averse, basically because of the investments that you do. You invest in government securities. As we know, the government is considered the risk, it's not risk-free per se, but is considered the least risky investment. We also invest in bank deposits, fixed deposits at banking institutions, which also have oversight from the Central Bank of Kenya, and also do a lot of quarterly reporting, just to make sure that they are still in a good shape. So how do you mitigate them? As an investor, you only have to look through their previous investment, their fact sheets. Most of these fund managers do monthly fact sheets to their clients and investors. You can go and look at and see where they've invested the funds, because they do give an asset allocation of where they've invested. Not necessarily the banks or what, but they do give fixed deposits a certain percentage, commercial paper or corporate bonds a certain percentage, and you're able then to check and see how they're investing your funds, and then that will enable you to even go through the list of fund managers and try and sort out which ones meet your risk profile and which ones do not. All right.
Okay. Thank you very much, Caleb. Wanjiru Mugendi is asking, will you advise one to consolidate all loans with a financier as a way to manage debt and design a payment goal and plan?
Sure, Wanjiru, yes, that is a good strategy, because if you do have all your loans with one financier, then you're able even to, it becomes a better negotiation between you and your financier and your financier, because you're able to come up with a better payment plan. And let's say you have two loans from two different institutions, but they're all both short-term loans. If they're both short-term loans, then you have quite a high interest payment liability every month to service these loans. However, if you did consolidate them within one financial one bank, then you're able to negotiate and come up with better payment plans that you also don't default on any of those loans. And if you had any collateral based on those loans, then you won't be at risk. So it's something that is recommended, though there are some there are some processes that might be required to go through. some procedures and the like, and for some it might not even be guaranteed. At least, let's say it's both bank loans, maybe you won't be able to move from one bank loan to another. I'm not quite certain if that's the case. If you have, let's say, a circle loan and another bank loan, whether they'll still be able to move. But between institutions, let's say, again, if it's two circles, you may still be able to move. Anyway, it is a big procedure, but it can be done. And if you have two separate running debt loans, then and the interest payments might be a bit too challenging. Then it's something that you can look at, because having them in one financier is better. Because again, it's even if you're able to collect them in one financier, even to their benefit that you're able to pay, because now the risk becomes more on their side if you are to default.
Okay, thank you, Caleb. Joy Omulele is asking two questions. Is a mortgage classified as good debt? And then when calculating your net worth, will you place a house on mortgage under assets or debts?
Sure. Mortgage is debt. Yes, I will say that it is good debt, because you're buying it because you want to finance your home ownership plan. You see that goal there. So it can be classified as good debt. And then the second question on the second question for Joy, just repeat it. I see it as some of when you calculate your net worth, will you place a house on mortgage and assets or debt? So your house will be an asset. However, your mortgage balance will be your liability. So your house, value of your house will come under your assets. However, the value of the balance on your mortgage will come into your liability. Basically, it becomes a bit tricky, because sometimes for mortgages, if they still have a charge on the home, then if you default on the mortgage, you see your asset might also get out of the net worth calculation. Usually, though, because of that issue about if you have a mortgage, is it how much your house is at risk of them repossessing it? Usually, in calculating your net worth, it reaches a point where most of the times you might not put your house as a calculation in your net worth, especially for individuals. We'll say high net worth individuals. However, for this case, if you have no mortgage on the house, then definitely will come into an asset. However, if you do have a mortgage on the house, you'll have to check out the charge to see if this if you do default on the mortgage, if they can repossess or reclaim that house. So you can actually do it in percentages. If you pay them your value of your mortgage by 50%, and the value of the charge is also reduced by 50%, then that 50% is only what you put as your asset.
Thank you. Another question from Kevin Trent. Can you expound more on unit trust? What are they and how to invest in them?
Sure. Kevin, unit trusts are part of a collective investment schemes. Basically, they are funds offered by fund managers that are managed in a professional way that invest according to a certain objective. So if it's a money market fund, it invests according to a certain objective. That is maybe provide stable capital appreciation over the short to medium term. If it's an equity fund, it invests according to a certain objective, maybe to provide long-term capital appreciation in the certain stocks or companies that we invest in. To expand more on them, we did do a collective investment scheme training. I think our team can assist you in getting the link to that particular training on unit trust funds. But as we mentioned, the most common ones are your equity fund, your fixed income fund, and your money market fund. And the most common out of all of them is the money market fund, because it's quite easy to invest and withdraw your money. It's very liquid and very risk averse. So in terms of possibility risk of losing your capital is quite diminished. Again, when you do the due diligence on your fund manager. Okay.
Okay. Thank you very much. And Mary Kabutsi is asking, how can I open a unit trust fund from the diaspora? Well, you can do this by downloading our mobile application called Jikuze, which is available both on Apple Store and Google Play Store, and sign up for an account. We hope that you have all the documents, and once you're verified, you'll be able to start investing in our GenCap Hela Imara Money Market Fund. And then Crispin Anjeru is asking whether we have an equity fund. Well, we are in the final stages of opening an equity fund, and I believe by the time we have our second personal investment webinar, we'll be having an equity fund up and going. And other questions. We are seeing the interest of people wanting to have the presentation that Caleb just presented. And well, you can have this and more in our YouTube page. Just go to YouTube and search Genghis Capital Limited, and you'll be able to see our channel there. And also you can, well, just trying to go through the questions. Caleb, just a quick one. Who are our current trustees? Just to jog up your mind.
Current trustees we have for some funds we have Cooperative Bank and KCB Bank.
Yeah, and then Solomon Otieno is asking, what are the tax implications with regards to a money market fund, a fixed income fund, or equity fund? And secondly, how can one link their bank account to an investment fund?
Okay, tax implications for the money market fund, fixed income fund, and equity. Basically, these investments are taxed as at source, basically by the fund manager. So because you're taxed on interest, we'll have taxed the interest before you withdraw. Basically, what it means is that once we invest in these instruments, the interest that we receive is taxed before we give you the return. So for a fund manager, we'll send you a tax certificate, and your onus now is to declare that investments in this money market fund, this equity fund, and this was the certificate, or this is what I was taxed on. Secondly, on linking your bank account to an investment fund. Okay, this one is also dependent on some banks a bit more digital savvy than others, but others don't give that option. So it has to be, you basically have to have a discussion again with your bank after you've already identified the investment fund that you want the funds to go to. Then they can be doing a direct transfer once your funds or your salary hits your account.
Thank you very much, Caleb. And there's also, while we are continuing in the webinar, we also like to inform you that we also have a Telegram page where we post news that are concerning the financial industry, that is both the investment banking and asset management. So you can maybe check on your chat section, and you will be able to see the link to join the Telegram group. Kevin Kakuti wants to know how much, if he saved in the Haba Haba challenge for a year and saved managed to get 93,200, going by last year's interest computation, what could be the approximate interest earned for the year? So I think this one will need us to calculate. And while we are doing that, maybe Caleb, you can also answer this. John Masharia is asking, what is the tax charges on return of money market funds? That is, I think, the tax implications in money market funds.
The tax implication, tax charges on return of money. I think what he's asking is if again you're going to be taxed on your money market fund return. Though we've already talked about it. Once you get the return, it's already net of. It's a gross. No, it's already net of the. We already taxed the. It's actually gross of tax. So basically, what you'll get is. Am I getting this question on the tax charges on return? So let's say we give a return of 11%. We've removed the fees from that return, but then what is still remaining is the interest charge, which is 15% of your interest. So before you withdraw, that one will again be taxed. So the rates of money market fund, they're not net of taxes, but they're gross. The net of it's gross of tax, but net of fees.
Okay, thank you very much, Caleb. And we'd also like to once again thank you all for attending this webinar. And we wish that you may have a happy investing year. That this year you may grow. Financially and achieve personal financial freedom. And we'd like to also tell you that we have this webinar once every month, and you'll be able to get the links to register for. You'll be able to get the links to register to the next webinar as soon as this one is over. And I think, Caleb, you have anything to close off?
No, I just thank you for your time, and I hope it was an informative webinar, something that is ongoing, and we do like looking at any topics. You can also suggest any topics that we want us to tackle, and we'll be open to do that. Thanks for attending, and have a good start to your financial planning year.
Okay, thank you very much, and we hope to see you in the next webinar in February. Okay, goodbye.
All right, thanks.